Thank you very much. We have a lot of people online. I thank you all. I hope you're having a great day. Again, my name is Eric Berman. I'm a partner in the Boise office. Joining me for this session is Leland Miller, also a partner in the Boise office. Today, we're going to be talking about getting ready for June 30th, for you June 30 fiscal year-end governments out there, and certainly bringing you a little up to speed as to what's going on at the GASB. We thought that we would talk to you about this year's audit, which so far has proven to be unprecedented in complexity due to the impact of COVID-19. We as auditors and you as preparers must think differently this year for sure, and certainly for the foreseeable future. Let's think about that for a minute. As preparers, maybe you ramped up for the annual audit by fulfilling the prepared by client list, updating your note disclosure, closing the books, preparing the basic financial statements and required supplementary information, and then finalize the audit, just like every year. It wasn't all that long ago, January, in fact, we were all like Telly from Sesame Street, worried about the impact of GASB 84, fiduciary activities. That was one of our, actually two of our webinars back in the winter of last year and early this year. And then GASB 87, following shortly thereafter of GASB 84. And then the looming redo of the financial reporting model. We were all really worried about that, and we did multiple webinars on navigating those issues over the past 9 months or so. How quaint that all is, almost prehistoric, in fact. Now, many governments are seemingly like many of us are, in survival mode, or as I like to call my every other Saturday evening excursion, foraging for food at whatever is left at the local supermarket. It is going to be very different this fiscal year end, this year. Different than many of us have seen during our careers. Sure, many of us went through the dot-com implosion, 9/11, Great Recession, all within our careers. But this one is going to be different and may be with us for a while. But as we say, the show must go on. How do we make it through June 30th together is the subject of today. And again, with me today is Lee Miller. He's a partner. Here's our contact information. Let's get to the agenda. Today's agenda, we'll discuss closing the year and what to expect from the audit. We'll then discuss some gap considerations, and then for those of us who are taking advantage of GASB 95, the postponement of the effective dates of certain authoritative guidance, we'll turn back on the way back machine and talk about the two standards that we thought we buried last year, but are back again for this year in the news. GASB 83 and 88. And then we should have some time for your questions. With that, thinking about how folks are nervous this year, Lee, do we have to turn the calendar into June 30? Do we have to do audits this year? Tell us what you think we're going to expect.
Yes, bottom line is, unfortunately, there hasn't been an extension or of that the audits do not have to be done. We've got GASB out there that's extended its standards. FASB did the same thing. The Audit Standards Board did the same thing for us auditors, but there hasn't been anything from state governments or the federal governments that says, no, we can defer all the audits for 3, 6 months or a year. So it is still there. It is something they're still going to have to deal with. This whole COVID-19 is just affected us all in so many different ways, and it's really going to drive how we're going to address and trying to do the financial reporting process, not only from an audit side perspective, but as well from a preparer. Of course, for sure, we're June 30th definitely going to be affected. It's still out to the jury for September 30th or your 12/31s, but I think right now we're planning that it's going to be affected, those dates as well, just so that we can plan accordingly. If anything, if we're doing any interim work, it is definitely all being done remote and trying to work with the different entities and everything. So, some of the key areas to focus on at this point, timing availability of personnel. You know, people on furloughs, people taking leaves, people not available in the office, you know, those type of things. Of course, technology, we've all learned very quickly how good our technology is, how much we really rely on for working from home, the amount of bandwidth that we have. I have a few boys still at home, and so between their different activities and school and of course their games and everything, I can tell when everybody's on the internet at once because it slows down um, really bad. And so, you know, we have to deal with from a technology perspective. You know, estimates, assumptions are going to be different, and then of course we're going to have a revenue impact as a result of all this as well. Now, I mean, the Bureau of Labor Statistics came out and they estimated that there's what, $981,000 sorry, number of people, state and local jobs that have been lost, that they estimate in April. You know, of that is about 80% are come from the local governments. I mean, there's 90,000, approximately 90,000 governmental entities throughout the United States. And so that's on average of 11 people per entity. And so that is a number of people that were affected, and that's just April. We haven't seen anything from a May perspective, and this we expect and continue that's going to continue on going forward. You know, with the available personnel and also working from home, internal controls over financial reporting are going to be affected as well. You know, the closing process, you know, is going to take longer just for the fact that a lot of times we're used to and have access when we're in the office. I know we've got clients that'll say, well, I'm working from home, but there's 1 or 2 days that I'm in the office and I can take care of that. So that's just going to slow things down overall. But we're also finding, as we've been doing summer audits at this time of the year, that while things have slowed down a little bit, we've still gotten a lot of the work done. It just takes patience on both sides, but you know, the amount of personnel that are available is going to affect that. We have found that, you know, corners are being cut or may be cut just for the fact that, you know, a lot of people have had to step away from their usual duties, day-to-day activities, and dealing with just COVID-19 issues from the different government entities, and depending on what's required and what's needs to be done is will dictate of people being pulled from their usual responsibilities. You know, timing may be off. And what we meant by timing is the fact that, you know, back in 2009, there's a Recovery Act funds that was, you know, it's announced in February, but we really didn't know much until May. Well, with all the funding or the potential funding that's out there, you know, there's a lot of funds that are coming to the state and local governments, a lot of questions. You know, is this going to be included on the you know, on your federal funds for your CFA? You know, does it have its own CFDA number, or we're going to have to include as auditors testing? And we haven't heard anything. We may not hear anything until late summer or early fall of how those funds are going to be treated. Also, you know, if there's some last minute additional funding could affect this year's, and so you know, we'll just have to wait and see, but that's going to slow things down as we continue to wait. And then in regards to those federal funds, we have not even received much of anything from OMB when it comes from the single audit perspective. And so all of these things with the personnel and the changes are going to affect us overall. You know, technology, as I mentioned earlier, we really are leveraging it. We're finding out the pitfalls, the things that are happening. You know, from our audit, we're going to be looking at using more advanced data analytics, you know, try to take advantage of the fact that if we're remote, what are some of the other things that we can do as we're trying to switch from that paper audit to the paperless audit. All of us are been on a lot more Zoom, you know, you know, Skype type meetings and everything. My days look pretty busy just with all the different Zoom meetings that we have. Now, of course, with that, we're going to have to gain, or we're already have gained the skills, sharing the screen or unmuting a microphone. And then, of course, you can see here a little bit humor here, wearing pants. Sometimes we got to be careful when we're on Zoom meetings that we're wearing appropriate coverage so that if we stand up, we're not going to be embarrassed. But, technology is just those things that we're trying to take advantage of, use it to get through the process, and we're really going to have to leverage it even more. The video conferencing, I think we've all learned, what is the best thing to do, what's not the best thing to do. People have worked in trying to create their background, the different platforms of make available, when to mute and when to mute off. Yesterday we were in an office meeting, and I had unmuted myself, prepared to say something, and right about that time, one of my sons walked in and started talking to me about ordering a pizza, and I forgot it was on mute, so we had this 30-second conversation everybody else heard as well. And so just trying to make sure that we've got the good skills and that we're doing those things to help the video conferencing. One thing I noticed, and that's something that we've been trying to work on, I think initially with the video conferencing, we felt like we had to invite everybody to be part of that video conference. And I think we're finding that we're trying to fine tune and just have those that are really necessary to be on there. Just that helps everybody when it comes to video conferencing. Of course, using web portals, whether if you have your own, or of course, as Bailey, we have our web portal as well that we've been using extensively. And so it's basically that we use that 100% at this point in time. And then just trying to take advantage of read-only access, information. We're very sensitive about the data sensitivity, having personal information, all those things that we're trying to keep to the minimum when we're passing documents between us as auditors and our clients. And so sometimes, we'll make it so it's only read-only access type of information. Flexible scheduling, but with all this is that we're going to have to continuously, whether it's update firewalls, have IT protocols in place. All those things are really important. One of our clients, what they found out when they went remote, they identified several key areas that were a breakdown in internal controls, and so that we've had to go in and help them kind of identify and fix those areas. And so it's just, we're going to have to be on top of it when it comes to technology. The fact it's not going to be the same as last year. We'll try to do what we can the same as last year, but there's a lot that we won't be able to, and we'll have to work together to get to that. So estimate and assumptions are going to change. If you're estimating for revenues, and what's the impact of that, especially from a budgeting perspective, forecasting, those are some of the things we have to take into consideration. I think for the state of Idaho, their April receipts were 60% lower than what they had anticipated. Well, all that flows down eventually to all levels of government within the state of Idaho. And so those are things you have to be taken into consideration. From an investment perspective, for most of the governments, it's, if you have equities or your debt securities, we still have that information. It's readily available. But where it's going to be more complex is if you're in the longer term type of investment time frame. You've got some alternative investments, you have some hedges, those type of investments that you're going to have to take a closer look at to make sure, just don't believe what's on the statement. You're going to have to ask the questions. You're going to have to get with the investment managers. We do a number of public pension plans, and that's the number one questions we get from board members is, from an investment side of things, what's the risk? And it's those hard to value alternative investments, because while the information at June 30th may be available based on 3 months worth of information 3 months ago, but it may take several months for other changes to kind of flow through, and so you need to have an understanding to make sure that's out there. Revenue shortfalls is something that we're all expecting to see. It's yeah, of course it's going to trigger some budget deficits. There might be some additional disclosures. Also, whether some of the bond covenants are being violated as a result of those budget deficits or the revenue shortfalls. And again, like I've already talked about, assumptions, same as last year, probably are not going to apply for this year. So I think that's one of those things where you talk amongst yourselves, you talk with your auditors, kind of bounce ideas off and see what's going on out there and how that could be effective going forward. One last thing before I turn it back over to Eric is that going concern, and that's always something that will that we always take a look at, but especially in these times with the uncertainty and downturn in the revenues and everything, we'll have to take a closer look. Now, I think we've got some history on our side where the going concerns from a government perspective will not probably be as bad as if you're in a for-profit world. And that's just for the fact that the 2008, 9, 10 years were, the last time we had the big drop. While there were governments that did file for bankruptcy, the number as compared to the total number of governmental entities is relatively small, but it is something that I think we'll be taking a closer look again for this time around. One of the things about a going concern is that it takes into consideration is 1 year after the date of the financial statements. Are you going to be basically in existence 1 year from year end? Now, there's got to be a lot that's going to get us to the point to even consider issuing a going concern paragraph, but it is something that we'll take a look at. We mentioned about revenue credits. Basically, that is just talking about the fact that where your revenue type bonds, are certain types are heavily relied on, let's say a stadium. Usually those come from hotel taxes and everything. Well, travel's down, that means those hotel tax collections are going to be down, so therefore you're going to be able to make your payments for those type of revenue bonds. And so, that's just going to be an area that we'll just be taking a closer look at. We'll need to continue and update and look at internal controls. Just as we already talked about personnel, the lack of personnel or changes in your processes and everything. And so, those are things we have to consider. Confirmation process may take a little bit longer, but that's something that, if you're proper planning, then that should be taken care of. And then of course we've got, you're changing your representation letters. So, Eric, I've talked about some of those issues, but what should the governments be considering this year to maybe different than prior years for the financial reporting aspect?
Thank you, Lee. There's going to be some significant changes this year in terms of financial reporting, even though GAAP really isn't changing per se all that much. Here, hang on a second. There we go. Let's go back in our full screen. Even though GAAP may be not really changing all that much because of GASB 95, we have to think about some other stuff. And Nanette, I need to change my screen. Thank you. And let's go forward one more. All right, there we go. All right, so let's just make sure. Come on, go back. Here we go. Clicking here. All right, there we go. All right, so there's certainly going to be a number of things that governments need to be aware of, which may impact decisions on your financial reporting, or there may be certain things that are in process. There could be operations that have been discontinued or idle If that is the case, asset impairment may be occurring. You can just think about it. For example, if say you lost a major grant, or it just doesn't make sense for a particular function or agency to operate anymore because of a lack of funds, there are going to be some idle assets that are out there. The word operation means an integrated set of activities that are conducted and managed for the purpose of providing those services. So, right around me where I happen to be, a library down the street is closed. Well, if you have a library that's closed, or a convention center or other capital asset that has a decline in services, it's up to you to analyze it if it has a decline in value resulting in a loss. Even if it's just temporary in nature, if it's material, it should be disclosed in accordance with GAAP. For temporary idle facilities, disclosure with their capital assets disclosure is where we usually see it. That's a best practice. Governments may have additional contingencies this year due to COVID. If the government has already calculated a rise in interest rates or healthcare costs for employees, or for the general public that they have to pay for, and so on. Certainly for states, a rise in IBNR is a given for Medicaid costs due to COVID-19. Those are going to have to be disclosed if it is material. And certainly for states, Medicare costs are going to have to be disclosed with a rise in the IBNR. And there could be additional liabilities that are out there. Uh, Lee mentioned revenue credits, and those are the ones I think that not only we as auditors are a little bit more worried about this year. Certainly, I know that the SEC has made some rumblings about them as well. And we'll talk about what the SEC has released in a couple of minutes. As a reminder, these revenue credits, they usually have to deal with transit, utilities, parks and rec, in other special districts. We already know of debt restructuring going on through concessions made by creditors. The restructurings could be beyond the normal bond refunding transactions that occur often, and certainly given the fact that the credit markets did shut down in March for a couple of days and then came back on. And that's why the Federal Reserve came in and did the municipal liquidity facility. Restructurings could be going on to take advantage of that. In some cases, governments may be transferring non-financial assets to creditors to satisfy debts. We're not sure how many creditors want to be in the municipal golf course business, but I wouldn't put it past them. After all, there may be some creditors who would love to own Torrey Pines if it were made available by the city of La Jolla, California, or TPC Scottsdale or Bethpage if it was made available by the state of New York. But by the way, I'm going to be talking about some of those asset monetization possibilities less than 24 hours from now on a webinar by the Volcker Institute, but governments are starting to make those rumblings. In any event, debt restructuring needs to be disclosed, including any modification of terms, rates, and dates. In some cases, governments may step into the shoes of another government to pay the debts in the form of a non-exchange financial guarantee, and that's done to preserve the credit of the debtor government. And certainly we're going to talk about that in a little bit, but just be careful if you're going to do these asset monetization transactions. They should not be taken very lightly. They need to be really considered in terms of the economic impact. Governments may still have demand bonds that are outstanding, although they are pretty rare. In some cases, counterparties in the transaction, say the investment bank or the lender, because of the way interest rates are running, they may have failed to fulfill their obligations. If that occurs, the bonds become current liabilities in a governmental fund. So just be careful if you do happen to have these demand bonds that are out there. Those of you with hedging transactions, hedging derivatives, that may have similar issues to demand bonds. In such a case, the counterparty in the swap fails to pay on the swap uh, simply because of the interest rate movement. They're going to be losing money if they pay on the other side of the transaction. In those cases, the hedge may no longer be effective. If that occurs, the deferred inflow or outflow of resources then needs to be recognized as part of the investment income along with the proper note disclosure. I talked at the outset of this section, disposals and impairments of capital assets. Disposals of operations could be linked to the idling or impairment of assets. So for example, if you don't need that library anymore, well, guess what? You may end up disposing the capital asset and, of course, the personnel that are involved with it. And we'll talk about in a little bit termination liabilities that may need to be recognized, unfortunately. Many governments may be looking to shut down programs, services, or reconfigure even their jurisdictions. We've already heard rumblings of governments considering transfers of operations as budgetary solutions, such as, for example, the creation of a public safety district. We've already heard of a government thinking about transferring its fire district to a regional system, to do a regional fire district, all in order to potentially get some budgetary savings. If a new government is created, it begins existence as of the date of the transfer of assets. And so we may be seeing a lot of these over the next 4 or 5 weeks. Gains or losses may need to be recognized by the transferring governments, and there could possibly be asset impairment. A government I was talking to, I was talking with another partner about this government, and I said, well, they may not need a fire station or a sheriff station because it may no longer be staffed if you create a regional district. Termination of employees may occur, and certainly there will be costs of such transactions. We do advisory services in this area as a firm. Should you be contemplating these activities? If you are contemplating these activities, please call us in advance because they are very complex. Once completed, the note disclosure is required along with gains or losses. And again, since they're so complex, we want to know sooner rather than later on these ones. So again, these disposals may occur. There's different flavors of them in terms of mergers or acquisitions. And again, the GAAP is pretty arcane in it, even though it's been in place for a while. Yeah, you also need to take a look at other costs that may be involved, including legal, accounting, financial advisory, and so on, all of which needs to be disclosed, and it is all part of your gains and losses. Governments may also have to judge whether COVID-19 costs are extraordinary. GAAP currently, and I underscore the word currently, deems extraordinary items as both unusual in nature and infrequent in occurrence. Now, it's unlikely that COVID would be a special item, as a special item under current GAAP is under the control of management. But a disposal of operation could indeed be a special item. My personal point of view is that if you did have a material loss due to COVID-19, that would probably be an extraordinary item, but that's going to be up to the individual government as to whether or not it's material and whether or not it's certainly extraordinary. Lee mentioned in the investment issues that we're going to run into this year. Special concern this year involves the fair value of investments. There could certainly be a high degree of uncertainty, especially for level 3s, investments that are at net asset value, and some level 2s. As Lee mentioned, again, don't just take the information from a financial entity without doing some form of independent analysis, even on a sample basis, to decide if it's fairly stated, especially for private equity. there may be early asks for contributions, late payments on distributions. Uh, if you do see some of those, that could be a problem. Just ask the former clients of Bernie Madoff, because that's essentially what was going on. We mentioned going concern earlier. Remember, GAAP is different than auditing. For GAAP, we need to consider 12 months beyond the financial statement date based on the information you have now. So what do things look like on June 30, 2021 is the question you preparers out there need to be asking yourself. You may already have a pretty good idea based on budgetary discussions, layoffs, service changes, conversations with creditors, and so on. These issues will be really scrutinized this year more than ever. Now, as Lee mentioned, many governments have been in existence for decades, or in the case of the government where I'm sitting, for centuries, and they will likely continue. But for some governments, there may be substantial doubt, and the word substantial is so important. We're talking serious, not just a downturn. In the case of an area solely reliant on tourism or discretionary spending without any other flows, a going concern consideration needs to be made. So Lee, how do you think this is going to be played out?
Well, it's really just going to come down to each government and their circumstances, of course. Sorry to be so obvious. You know, a few years ago, I did some research and put together a presentation talking about bankruptcies of government entities. And, of course, the first thing everybody was asking, well, we were surprised why wasn't anything said, um, you know, and so I think it's a lot more on the forefront of people, especially now that we're seeing with this COVID-19, being a little more sensitive about the different entities that are out there. But the thing that I found with that bankruptcy was that, with your general governments, yeah, they had difficulties and everything, but they're able to pull through because of the different revenue sources. A lot of the times where we had problems were the ones that were maybe a special district. They had too much debt. They're, I'm thinking of a water sewer type of an operation that they just got too much debt, and the number of customers that didn't come on like they were anticipating because people had a choice. Just all the kinds of different reasons that caused them to have to file for bankruptcy. But I think the thing is just that the different government entities need to be aware these are considerations to take. Like as Eric mentioned, really not seeing that there will be an uptick because of just COVID-19, but I think we're just more sensitive about it, and that hoping to be able to say, okay, well, how are things looking, and ask the tough questions so we can see what we can do looking forward and try to address any issues that may come up.
Yeah, I think those are good points. I think about it, for example, on public institutions of higher education. Now, obviously, state universities probably won't go out of business. Could there be a restructuring? Well, sure. And could there be challenges? Absolutely. Look, the California State University system already announced that they're not going to be opening up in the fall. They're going to be going online. What does that all do to tuition and so on? Remains to be seen. They're in a state north of where I'm sitting, here in New England. They announced that they were going to merge community colleges into the state university system. Well, that met with such an outcry, that they may be reversing that decision, but the problem still remains. How are we going to fund the community college system? And that all goes into going concern, whether or not those community colleges will actually continue, or will they be merged? And so those are the sort of things you should ask yourself as you prepare your financial statement, and think about it as in terms of your management's discussion and analysis, because it will be a currently known fact, decision, or condition. And certainly before we finalize things, or you finalize things, you may want to discuss it with your legal counsel because it becomes a public document. So speaking of the management's discussion and analysis, the Securities Exchange Commission did issue a statement on May 4th that we're talking about 4 weeks ago, and you can read it on your screen. They understand that they don't really have direct status over you as a bond issuer, but they do have status over your bond holders, which happen to fund a lot of your operations and the underwriting function. And so when we send out to you the PDF of this presentation, you may want to bookmark this page and think about that when you're writing the MD&A. And you should disclose your current situation, your current financial situation as part of your MD&A this year. And that leads to a further discussion. Don't just take last year and fill in the blanks. And I know that I've done that in the past, you've done that, and so on. We all wink at each other and so on the MD&A. If there's 1 year in my entire career since the MD&A came in, back close to 20 years ago now, of course, there was an introductory letter in the old CAFRs prior to GASB 34, but this year it really means something. Each word will be precious. Remember the true norths of MD&As. Remember to answer the question why, based on facts, decisions, conditions, and other activities that are currently known prior to the release of your financial statements. Don't look at your neighboring government. I know you do it. We all do it. And let's all agree that we all do it. This is the 12-step confessional here. This year especially, that information may be suspect. Every government is dealing with COVID-19 differently, so please be careful. Remember that the focus is on the primary government, not just not discretely presented component units. Their disclosure is up to your judgment. Disclosure of known items can be long, and certainly remember materiality in this respect. Materiality is important when we're thinking about the MD&A. For public institutions of higher education that closed after spring break and may not be back in the fall, like I mentioned, the California State University system, that is likely a disclosable item. CARES Act funding or any other funding received could be a disclosable item. Furloughs, early retirement incentive programs, budget adjustments, and so on should all be part of your MD&A as applicable. And I'd say for sure this year, make sure somebody else reads the MD&A, perhaps more than ever. A best practice is to involve your counsel. Remember, every word is precious in the MD&A this year. Don't wait until the last minute to finalize it. It might be worthwhile to get it started. If you do happen to have some time, we know that your time is precious. But if you do have some time, get started on it as soon as possible on the MD&A. As I mentioned, governments may be party to non-exchange financial guarantees that will be or have been exercised in order to retain credit. Liabilities may need to be declared by the receiving government to the paying government until it's released in some form of receivership or bankruptcy. The paying government will have an additional liability for the present value of the cash flows as a result of the guarantee. One government reached out to me and asked where could we get that information. The best place is from the other government's debt service schedule. And so certainly take a look at that as if you happen to have this going on. Lee mentioned revenues, and what we're really focused on this year is the collectability of revenues. Perhaps the allowance accounts for taxation. They may have been established a long time ago and may not have been documented all that well. because we always assume that 3% of property taxes or 5% of property taxes might not get paid, or maybe paid over a longer period of time. From what we understand from the economists in the room, there's going to be a delayed reaction on property taxation due to the time it takes to foreclose and the various moratoriums on utilities and payments of rent nationally. Other revenue accruals may need to be examined as well. And again, if you happen to have a housing authority and if there's a moratorium on the payment of rent for 6 months, you got to take a look at that accrual. Certainly utilities in terms of shutoffs and so on. And so you need to take a look at those revenue accruals this year. The same holds true for expense accruals. Governments will assuredly delay payments to contractors in order to preserve cash. An organization that I'm sure you and I deal a lot with, the GFOA, even suggested that as a way to preserve cash. Now, obviously, you got to follow the law. And if your law says you got to pay your bills in 30 days, then pay your bills in 30 days. But you may have been paying bills in those 30 days during good times, but you may be allowed to go out to 45 days without incurring interest. Well, again, if the law allows, chances are you're probably going to be taking advantage of the law. But make sure you align to the law. Tax lien and payment dates that you may be disclosed in your note disclosure, they may have already been adjusted. So take a look at those dates in your note disclosure before we get there. And you may also want to discuss the adjustment of those dates in your MD&A. In some cases, it may make economic sense to sell receivables or future revenue streams. Doing so is a way to monetize an asset as long as it's an actual sale. But to have an actual sale, you lose control of those receivables or revenue streams. Once it gets done, that sale becomes a one-time solution, but it doesn't solve a longer-term problem. After all, those revenues will need to be replaced somehow. Right now, the interest rate on calculation on the savings from the sale of revenues just doesn't make sense in many respects. Other governments may be contemplating transferring non-financial assets into defined benefit plans, again, as a budgetary solution. I know of at least one financial advisor discussing that with various governments around the country. GAAP requires such transfers at carrying value, net of any form of consideration from the plan in return. But the practicality of it may not make sense for many governments because the plan is going to demand assets that generate revenues to pay benefits immediately and not to be returned to the primary government. And again, once the asset is transferred, it's gone. That said, I can see a good revenue generating asset such as a heavily traveled toll road under normal circumstances to be a potential solution. However, these are not normal circumstances. And if traffic is expected to never recover, transferring, say, a toll road to a plan might have to be at a discount. Public utilities may be a different story depending on legacy costs such as asset retirement obligations, which we'll talk about in a few minutes. Disclosure is also required of significant violations of finance-related legal or contractual provisions. Remember, these include revenue bond covenants or ratios, grant violations, construction stoppages, and so on. All these things are going to be required to be disclosed if they do occur. We sometimes misdisclose subsequent events, such as the passage of a budget or a bond sale. Those are normal operations and don't need to be disclosed, even though we all do it. It's really not required by GAAP. But remember, there are two types of disclosure, those that existed at the date of the financials and those that didn't. COVID-19 costs likely exist and perhaps are already part of your accruals if you made those changes. And if you made the changes in the estimates, you've probably already disclosed it in the notes or in the MD&A. Just remember when you do get these PDFs or you print these out, this might be one page you might want to remember is when do you recognize a subsequent event? I did mention termination benefits a while ago. If your government has announced layoffs or terminations, there may be accruals required for incurred but unpaid costs. In some cases, early retirement incentive programs will increase defined benefit and OPEB liabilities. Certainly that happened on my watch when I was a preparer back in the Great Recession. They gave us furloughs in exchange for additional service credits. And for older employees, they offered early retirement incentive programs to go into the state pension plan. I'm sure we're going to see those again. In some cases, again, that will increase your defined benefit pension, and in some cases, OPEB liabilities. It does solve a budgetary issue, but again, the long-term liabilities may increase. Further, your rates are going to rise to those plans because fewer people are working, contributing to the plan, and that means the liabilities will increase. Really quickly, let's go through some GASB standards you should consider for June 30. Before we go further, let's take care of the elephant in the room. Many of us know that the GASB has provided relief on some standards, but not all GAAP. Someone who is not a client asked if they could prepare cash basis financial statements. Well, if your state allows a special purpose framework such as cash, well, that's between your state government and your government. But otherwise, GAAP is required. And we know that many states do allow for very small governments out there, cash or some other budgetary basis financial statements, and that's fine. Statements 83 to 93 will now be postponed for a year, except for GASB 87. GASB 87, you can all throw your hats in the air. Leases was delayed by 18 months due to revenue-sensitive governments such as airports. And so that's going to be delayed 18 months. And there is a little bit of a minor problem with the implementation guide update, which I know the GASB is going to be discussing in the June meeting. This was our calendar prior to May 8th, and this is actually a slide we used from earlier this year in a webinar with some other stuff filled in for pending stuff. And notice we were going to have a pretty busy year coming up here. Let me see if my highlight works. Yeah, let's see this highlighter here. We were going to have this pretty busy year here with GASB 84 and GASB 90 and so on. And then right after it, we were going to talk about GASB 87 leases. Well, happy days, folks. That's all changed. And the big changes are this year, for the year beginning after June 15 of 19, which is this year, the only things that are on the board are Statement 83 and 88 and the implementation guide from last year. And if you've already implemented them, well, guess what? Keep going on GASB 84 if you were in progress. This gives you a little bit more time to implement GASB 84. And then look down further down below on June 15 of 21, we're looking at GASB 87 and GASB 93. We do have some other GAAP standards that are out there. GASB 94 will be implemented in 2023. And hot off the press, just approved on Tuesday, that would be yesterday, GASB 96 was approved yesterday. Subscription-based information technology arrangements, that also came out with a June 15, 2022 date. We'll get to those in future webinars, but for now, the delay is a benefit for many, many governments out there. Even the implementation guide update is unusual for this year as it's dated 2020, but it has an implementation date of 2021. Now, there are 3 questions in the implementation guide update which are deferred, which discuss defined contribution and defined benefit plans that do not have boards. 2 of those questions, 4.3 and 4.5, will be reintroduced in about 2 weeks into what will now be GASB 97. That is slated to be approved on June 14th, and it will be coming later on and published later in June. One question 4.6 will be permanently superseded. So, what to do for this year? What do you need to consider for this year? Well, if you've implemented GASB 83 and GASB 88, well, you are done. That doesn't mean you should hang up on the webinar. After all, we have about a half hour left, maybe a little less. If you are most of the way there to GASB 84 and believe you can finish this year, great, go for it. We encourage you to do that for June 30th because that'll just put you ahead and you'll never be behind the 8 ball. But remember, do not implement GAP piecemeal. Don't pick and choose questions in the implementation guide as they're now authoritative. So if you're going to implement GASB 84, remember those implementation guide questions become important. And also remember that we are going to be thinking about those 2 implementation guide questions that are in the implementation guide update 2020. They may not impact you directly, but if you are implementing GASB 84, just take a look at the implementation guide questions, and we can certainly chat about that separately as you go forward in the audit this year. I mentioned what will be GASB 97. This will be on 457 plans and similar. They will have an impact on GASB 84 implementations. We're thinking about doing another webinar on this, maybe later on this summer. If you are implementing GASB 84, you can hear about the changes that may be needed then. So just watch your inbox coming up for another webinar. I mentioned GASB 83 and 88. Again, those will be the only standards implemented this year. For those who have forgotten about those standards, let's just take a few minutes on these. 83 deals with the permanent retirement of tangible capital assets. And again, it's permanent. Complete removal from service, whether acquired or constructed. There must be some external event requiring an asset retirement obligation and therefore a legally enforceable liability. And again, it needs to be some form of external event, either a law, court case, something like that. So far, the impact on states and local governments of GASB 83 has been minimal in terms of numbers or counts, but high in terms of dollars when they've been found. If you think about the tangible capital assets that may be involved, decommissioning a nuclear plant is expensive. Capping and dismantling a drilling platform that was acquired due to seizure is expensive, and so on. Where there would be problems in implementing is that so far has been the confusion with similar gap related to, for example, GASB 49, pollution remediation obligations. In some cases, GASB 18, municipal solid waste landfill calculations, financial reporting, and so on. Or in the case of tangible capital assets that are going to be continuing to be used. Well, if you have a tangible capital asset that is going to be continuing in use, GASB 83 doesn't apply. 83 is only for the retirement of those assets. There are lots of exclusions in 83, including pollution remediation, landfill capping, contingent obligations to perform ARO. Those are all exclusions that need to be addressed and need to be set aside. If you happen to have a minority share of a capital asset, a minority interest in a plant or a dam or something like that, there is limited disclosure, especially in the case where the plant owner or the dam owner is using FASB standards. Since they're using FASB standards, slightly different financial reporting. Yes, you're both using accrual accounting, but you may have a different measurement date much like a pension plan. And that measurement date may be off cycle from June 30. And just like in a defined benefit pension plan, as long as you get that information from the owner or the controlling interest in that dam or nuclear power plant, as long as you get that within the fiscal year, you can still use it and record it just the same way as you would a defined benefit cost sharing multiple employer and a defined benefit. And again, it would be limited gap that's involved with these and limited note disclosure that's involved with these. The liability recognition is very much like pollution remediation. Again, there has to be some form of external event and internal events, or else there would be no liability. It just becomes note disclosure otherwise, and perhaps maybe just part of commitments and contingencies. And that's where we're seeing a lot of this disclosure so far, where ongoing operations may happen to have an ARO that may be attached to this. And if there's no liability because there was no external event, well, it's an internal event, and it may be a commitment or contingency. Once a liability is recognized, the debit offset is to deferred outflows of resources until the asset is retired, unless the asset is abandoned before it comes on operation. So it really becomes a statement in net position disclosure only. It's not a P&L event. The liability calculation is a present value calculation, just like GASB 49, pollution remediation. And just like pollution remediation, it will involve likely a professional engineer's certification. And since the professional engineer certification is needed, we're going to be testing a lot like of that certification. The liability may be adjusted up or down on an annual basis by similar changes to what would have occurred in pollution remediation. And that liability will adjust up or down based on inflation or deflation, technology, changes in the law, contracts, judgments, and so on, or changes in technology, changes in equipment that are needed to retire the capital asset. If the adjustment occurs before the asset is retired, well, it just adds on or subtracts from the deferred outflow of resources. If it's after the retirement, well, then it becomes a P&L impact. The deferred outflow of resources is recognized ratably over the useful life of the asset through an amortization. And so you just debit amortization expense, credit deferred outflow. If the ARO is required to fund up an account, and you see this a lot in utilities, the funding up needs to be a restricted asset. Any costs to comply are just outflows. They're just an expense transaction. And if there happen to be bonds that are sold to finance the asset retirement obligation, well, that's a separate liability. The note disclosure is pretty straightforward. Who, what, where, when, why, and how much would be required to be put in the note disclosure. And again, the note disclosure we're finding on asset retirement tends to be close to commitments and contingencies. The note disclosure in minority situations are slimmed down from situations where the government owns the asset wholly. Just the total amount of the ARO shared and the date of the ARO measurement, and if there's any funding requirements that are needed, and the amount of assets restricted for the government's share of ARO, if it's not disclosed for separately. Putting everything together, this is one of those pages you may want to dog ear or print out if you do happen to have an ARO. The initial recognition is not all that tough to take. Again, a P&L event would not be recognized. After the initial recognition, you recognize the deferred outflow as an amortization expense systematically and rationally, and then the liability would amortize as well. Auditing so far, pretty straightforward stuff. We're going to take a look at what the engineer has reported to you, take a look at their assumptions, independently verify those estimates if it's material, and we may even confirm restricted assets because usually they're held by a trustee. And the implementation of this does require a prior period adjustment and a restatement of beginning balances. Let's go forward to 88. Now, as I say here, remember 88, certain disclosures related to debt, including direct borrowings and direct placements. This may impact more governments than 83 due to the updated definition of debt. And the effective date is now. So what's the updated definition of debt? It's inside the box here. And so again, you may want to dog ear this page as well. The definition of debt for disclosure purposes is a liability that arises from a contractual obligation to pay cash or other assets that may be used in lieu of payment of cash. And that takes care of your swap payments. In one or more payments to settle an amount that is fixed at the date the contractual obligation is established. And any form of variable rate interest or capital appreciation bonds and so on, or zero coupon bonds, which are capital appreciation bonds, of course, any sort of those variable rate debts, those are still going to be debt for the purposes of disclosure. For disclosure purposes, debt does not include most leases unless they are financings, and it's why GASB 87 kind of was issued. It doesn't include accounts payable for the purposes of debt disclosure because those are typically short-term in nature. Based on the definition of note disclosure, most governments have adjusted their note disclosure, but for others, it's kind of a work in progress. Only summarized information is required. And separation of disclosures for direct borrowings and direct placements is required from other forms of debt. Here's sort of the checklist of elements that would be in there. And again, we're talking summarized information, not details on things like unused lines of credit, assets pledged as collateral for debt, any forms of default of finance-related consequences or termination events, some of which we talked about a few minutes ago, that would probably go in the MD&A as well. And any form of subjective acceleration clauses that would be in your debt disclosure. I've mentioned a few jargon words out there. Direct borrowing is when a government enters into a loan agreement with a lender. And you see these a lot where a government deals directly with a bank instead of going out into the market and selling bonds. A direct placement is when a government issues a debt security directly to an investor, and these are typically large mutual funds that hold municipal securities, and you see these in almost every state where there are high state taxes, and if there are high state income taxes, investors want to buy things like direct placements. Lines of credit are different than letters of credit. A letter of credit is a guarantee of payment. A line of credit is a full agreement to receive resources that are available to draw. And those of us who are homeowners, we know the difference between letters of credit and lines of credit because we may be utilizing them for our homes. Assets pledged as collateral are different than what we may have been doing before. And sometimes we get that confused. Previous to GASB 88, we disclosed revenue pledge to pay off things like bonds. Well, you don't need to do just revenue. Now you need to do the balance of assets. And so what we've seen in practice is if you do have this situation, you disclose the revenue that was pledged for the current year plus the asset balance. So it's not too tough to take. Putting this all together, the requirements are slimmed down from prior years, and many governments have embraced this. The 5-year table is still there, but the changes in long-term obligations table that may have gone on for 4 or 5 pages is now the exception. That's not the norm, and common disclosure items are on these slides. And again, you may want to print these out and check them off as part of your disclosure items. Your core disclosure items are going to be on the left-hand side here. And again, that the main things are the 5-year to maturity, the unused lines of credit, the asset pledges, and so on. On the right-hand side, these would go into your change in long-term liabilities or obligations table. And again, look at the line that says leases, only the amounts that are financing. Compensated absences will go there for now, although wait a little bit later on into this year or early next year, you may see an exposure draft adjusting how we do compensated absences in the not too distant future. And then payables to a defined benefit plan as applicable. That's where if you fall behind on your payments into a defined benefit pension plan as a government, and the payments to the plan are set up in the form of a long-term payable, sort of like a mortgage that is separate from your pension contribution. Well, that could occur simply because governments may not have the money to pay for the current pension contribution. And if that's the case, that would go in that long-term obligation schedule. Any form of demand bonds, defeasances, refundings, and derivatives, of course. This is what one of our clients issued for this year. Pretty straightforward stuff. Notice on the left-hand side the elements that are there. Notice there is, they put in rebatable arbitrage, and that's fine. They did pay it off this year, and so that's certainly fine. Accrued compensated absences is in there. They separated out governmental activities, revenue bonds, and then business type activities, revenue bonds. The landfill post-closure is there. And then it kept going into the various component units, but something like this would work very, very well. Here is additional information that they listed. They listed every single bond issuance that are currently outstanding. By the way, the listing of interest rates, that's not required by GAAP, but it is a checklist item for the GFOA. And we're seeing a lot of our clients do this, and it's actually a pretty good information for your decision makers. This also has a final maturity date and an authorized but unissued amount. When I was a preparer, we used to do that all the time, the authorized and unissued amount, along with the maximum annual debt service. So this is actually pretty good information that's there. And so you may want to take a look at that if you're preparing your GASB 88 disclosure. Here is your 5-year debt service schedules, the first 5 years principal and interest. And what this particular government issued was by different functions of government, and that's not required. All you need to do is just the aggregate by governmental activity and business type activities in the aggregate, but the government decided to do this because it was good decision-making information. You could have additional information based on the elements in the text box in the lower left-hand side. Notice I put in certificates of participation and CDOs. Remember, in a couple of years, we're going to be implementing GASB 91. So in some cases, those CDO disclosure may change. And also remember, I mentioned pledged revenue and assets. What we found where we found information in implementing GASB 8 was largely due to a lack of communication between the finance people and the preparer team, especially in direct borrowings, in direct placements. there may not have been any disclosure on direct borrowings and direct placements. And you really need to have that open communication between your financial staff, maybe your trustee staff, and your preparer staff, to make sure that you're not missing anything. And again, especially in direct borrowings and direct placements, care needs to be taken in that disclosure. And again, this is one of those note disclosure items that you can't really copy from prior years, looking forward into this year in implementing GASB 88 if you haven't done so already. So with that, we do have some time for questions. And God, I love that picture. We do have some time for questions. So with that, Nanette, do we have some questions in the chat room or raised hands or Q&As?
Let me look and get rid of all the ones that have to do with polling. So I apologize for the new process. I think we need to make some adjustments. We have an anonymous attendee that asked to dive deeper to asset impairment.
Mm-hmm.
So that might be something just to consider. They don't really have something specific.
Okay. All right. Well,
Wasn't GASB 88 postponed with the issuance of GASB 95? Effective date is now years ending June 30th, 2020 and subsequent.
Well, let's talk about those two. All right,
Okay.
so those are effectively two questions here. So the first question on asset impairment, if you have idle assets, so let's say, again, you have a library that's not going to be used for 6 months because of budget constraints, or it may be only reopened at half capacity. Or let's say because of a shutdown of a program in a college or university, you're no longer going to be needing a particular building. Well, those are idle assets, and if they're material in terms of carrying value, you need to disclose those items. Now, again, it's going to be different for each individual government that's out there in terms of idle assets. And Lee, if you want to chime in, please feel free in terms of that. And so, again, it comes down really to materiality. Now, if you're actually going to dispose of those capital assets, different story. But the test for impairment becomes really important this year. Now, what was the question, Nanette, on 88?
Was it postponed with the with the issuance of a GASB 95?
Okay, so yeah, let's clarify that a little bit. So the original implementation date of 88 was for periods beginning after June 15 of 18. And so that's July 1st of 18 to June 30, 19 for you June 30s that are out there. By my iPhone, it says we're headed towards June 30 of 2020. And so we are in that postponement period, which means that you implement GASB 83 and 88 this year.
I think that's everything that we've gotten. I'm trying to look in the chat, but it just is related to the implementation also. So I think you addressed that question. So I think we're okay. We can give them their checkout code.
All right. Well, I do. Actually, there was one here. It says, question that I was seeing in the chat. Question 4.7 of 2019 is about GASB 33 when to recognize revenues for a non-exchange transaction. Because of GASB 95, is it true that this question would be applied for periods after June 15, 2020, and this question would not be allowed for periods before June 15, 2020? That's actually a great question. Well, if you are implementing 2019-1 as you would have normally implemented this year, absent GASB 95, you should implement it. Don't piecemeal it. You should implement that early if you are going to implement the rest of the implementation guide early. And so just be aware of that and certainly disclose that to your auditor if you happen to be a preparer.
Eric, we have another one about 457 plans without
Okay.
board and employee contributions. So just when.
Okay, all right, well, that's going to be an interesting situation now. We don't have the final language on 457 plans. And so please take this with a grain of salt. And if you hold me to it, I'm going to say I didn't have the final language. The final language is due out in a couple of weeks. That said, from what we understand, the 457 plan has to meet the definition of a pension plan, and by strict definition, a 457 plan is a deferred compensation plan, which is different in the eyes of the Internal Revenue Code. How does it meet a pension plan definition? Well, are there separate accounts set up for the 457 plan participants? And in some cases, there may be a contribution from the employer to match the employee's contribution. But if all it is the employee's contribution, and maybe it goes over to a third-party administrator, in some cases, the 457 plan may not be reported. And that could be similar to other employee benefit plans that have no employer control or employer involvement. There may not be reporting of them. We'll see in a couple of weeks. I'm not sure exactly where it's going to head, but this could cause a change in how we think about deferred compensation and defined contribution plans in GASB 84. Anything else, Nanette?
Our only other question that came in was just having access to the slide deck and webinar presentation. And we will be sending out the materials with the presentation in a follow-up email, which will be provided within a week. Usually it's 7 days by the time we process the video and get everything sent out to them. So you should have it within a week.
And then somebody texted me, is that a picture of my grandson? Yes. He just turned a year old last Sunday. And so he always has questions. So he's a cutie. He has 8 teeth and biting everything. So with that, checkout code. Let's go there. First of all, we thank you. Here's our contact information, and here's the checkout code. Checkout code is Chairman, CHAIRMAN. And with that, we thank you for your participation today.